Here he is.
Welcome to my favorite part of my job,
That's right.
debt-free call. If we cast our minds back, sitting in your living room with Adam, actually,
Yeah, yeah.
and I sat there and I said that we should be able to pay a house off in 10 years, and I think there was a little bit of skepticism from Jamie.
No,
Um,
me.
she was thinking, yeah, it sounds good, but all things that sound too good to be true usually are. You took the leap of faith and said, you know what, we've got nothing to lose. Let's roll the dice and see how it all pans out. So here we are, 7 years later. You are debt free, and this is the ultimate achievement financially.
Mm.
Most Australians, 60% of them don't pay off their house before retirement. So Wolf, man, and I know there was some talk about getting a bigger, better house and all these sort of moves. You guys, no, no, you just were disciplined, stuck the course, and here
Mm.
we are, free from mortgage prison. So I'd love to have a quick guess at how much do you think you paid off your house in how long a period of time?
Ooh, okay. Well, what do we think?
Don't know.
We did pretty well in terms of, yeah, putting extra money against it when Jamie's had sort of bonuses and things.
Yeah,
But
Jamie's stepped
okay,
it right up.
yeah, yes, done the legwork.
Like to take care of my man.
Yeah, that's
Yeah,
right.
doing a phenomenal job.
Sugar mama
Yeah.
here.
World needs more Jamies.
That's right. No, hit us with it. How much did we pay
I
off?
want you to have a punt first. I'll
Oh,
definitely hit you with
okay,
it.
yeah. Hmm.
I really
7 years. 7 years. How much you reckon you paid? How much debt you reckon you paid off in 7 years?
God, I mean, in 7 years,
how
what,
much was the mortgage?
200 and
We
Yeah.
started we start at 285.
Mm.
yeah. So
So then we had a few little renos and whole
yeah,
Yeah.
that's
and
it.
bits and pieces. So
Let's go a round number, like what, 7 years, 200,000? Would that be right? Or
Sure.
yeah,
I
sure.
have no
Yeah,
idea.
yeah. Yeah, no, we're hopeless with this. That's why we're with you guys.
that's right. That's right. So if you did nothing else and didn't do any renovations and just stayed the course, you would have paid $285,000 off in 7 years.
To 85 in 7.
285 in service, but you didn't do that. You thought, you know what? We want to do some kitchen stuff. We want to do some other bits and pieces around the house. We want to get over to Korea, have a look at what Canada's doing. And so we did, we paid 360,000 off the mortgage in 7 years.
360,000.
Wow, that's great.
Yeah, yeah,
And managed to do all that. Yeah. Yeah, that's great.
yeah.
Mm.
That's
Wow.
it. So, if I can just ask one favor, if you can just tell me what you did, and I just want to snippet that for my socials there because it's an unbelievable result. $360,000 off your home loan in 7 years. Hit me.
And I would add to that before we even answer that question. Like, we're not necessarily the type of people I would have thought that, like, you'd have a whole range of people that would be with Crown, but I don't count Jamie and I as being the sort of high end, high earners necessarily. Like, I'm a social worker, Jamie's in IT. I mean, we're not bankers and in finance. Like, yeah, so that sort of money, I don't think
I
would
think we're making
come
okay
to us.
money.
Well, yeah, but yeah, we are both on six-figure salaries, but I don't know. Like, I think when I compare it against those that have
It's my bonus.
higher incomes, it's your bonuses and Invado paying you, yeah, that big payout at the end
Well, the
there.
last payout was the
Yeah,
biggest one there.
yeah,
that
that's
we-
huge.
Yeah.
Um, yeah,
Mm.
yeah.
But
So, if you could do that for me, Sam, so I paid $360,000 off my home loan in 7 years.
Mm.
Can you say that for me? I just want to do a snippet of it.
Yeah, yeah. I paid $360,000 off my home loan in 7 years. Yeah,
Wow.
yeah, that's it.
Wow, man, I get so I've had so many clients over the years, and I
Wait,
get
wait.
yeah,
Yeah, sorry.
we
I shouldn't
paid.
have owned that.
yeah,
I should have
he,
said it. Yeah,
he did. He acts like the breadwinner. Um,
yeah.
I've had so many clients over the years, and I sort of have little personal bets with myself as to where these clients will end up and how like you guys have surpassed my greatest wishes and what I thought you'd be doing versus what you did. You absolutely blew me out of the water. So I just want to say congratulations. You have finished
Thank
one of
you.
the greatest financial milestones in Australia. And now is the fun part where we start talking about what's next.
Mm.
That's it.
So I've got a lot of ideas I'm about to run through with you, but I'd love to hear what your ideas are, what you're feeling with this newfound mortgage freedom.
Well, I know number one thing for us, and the first thing that will come will be another family car, not another, sorry, a new family car to replace our old one. So the idea,
When you say new, like
no, not brand new, sorry, secondhand. But we want to get one that's fairly modern, like so.
Yeah.
Secondhand. Our top three picks would be they're all hybrid cars, so like a Toyota 4, maybe a Hyundai or a Kia. But the price range, even at secondhand, we think will be between
About 30.
probably 30 to 40,000.
Yeah.
We'll obviously trade in our old car, but that won't bring in a lot of coin.
And now we're not
Um,
doing this just because we paid off our mortgage.
No, we do need a
Our
car.
car is about to fall apart.
Yeah. At that last legs. So that will push us back into owing a bit of money again. But I imagine, Scott, that that's what people do when they're in this sort of privileged position that we're in now, is that we've still got an open mortgage in the sense that we could go back into debt a little bit to get the car and pay that off, right? Like
that's what everyone does. So most people, not everyone, most people in your situation, I get to do this every 23 days, which is cool. So most people want to just keep the facility open. It doesn't cost them anything to have those funds there. That means you don't have to reapply for anything if you need, like this car loan, prime example. Like if you had closed that facility down, then like now you've got to go and apply for a car loan. So you just use this facility as it is, pay it back down to zero again, let it sit there. And once it's back down to zero again after the car, we then need to redivert the income. So we've got all your cash flow going towards savings and building up some nice buffers there. And that's going to be a weird feeling, just having stacks of cash just building up. And then so that's once we get back down to zero, we then just put all incomes into our spending account. We then start saving those. You can even run like a quasi version of like, okay, we have a separate spending account and then all the salaries go into your savings account. Start building up those savings. So then you've got basically just investing and lifestyle to worry about. And that's where it gets unbelievable fun. We should be doing Canada annually. At least every year, just because when you're debt free, you've got choices. And basically, even if you just put half of the saved cash flow, because you no longer have a mortgage payment, into investments and put the other half into lifestyle, man, you're just never going to have to worry about money again.
That's nice.
Wow. Oh, so that's good to even hear you say that, because that is still like, that's a learning, I know for me. I don't know about you, but I hadn't thought about sort of rediverting, as you say, some into sort of a separate savings account like that. But it makes sense that we'd
are there any good savings accounts that
there's
give
a
us
lot? Absolutely, everything you need I have for sure. So we just haven't spoken about any of that because it hasn't been relevant, but now it's all on the table. So let's pretend you do the car. You've got obviously a little bit of a buffer already built up. You're in credit, so there's about 26,000 there.
There you go. Yeah.
So that pretty much like wipes out the car after a month or so. You might need another 6 or 7, grab the car, wipe that out, and then we're back at zero again. Then we get salaries, redivert into the spending account. I'll then, as I said, if you're wanting to set up a separate Visa debit card for spending, a lot of my clients are using a Bank West debit card because they get Qantas frequent flyer points for all their spending on a debit card. So it's called a Bank West Platinum debit card. So they use that for their spending. All the savings sitting in your savings account. Then from there, we want to probably start to make sure that's growing, so it's actually keeping up with inflation. Some clients put money into like term deposits, groups like Macquarie, ING, really, really good in terms of what they're paying. Other groups are another group called Plenty, Plenti. They do 1 month savings accounts, paying about 5-6% per annum, which is great. And then we need to sort of talk about, okay, that's happening. We should be then moving to start salary sacrifice and maxing out your contribution. So you can put in 30 grand each. And so your employee's putting in 11% of your gross salary. You need to be putting in that top up. And so you're getting all that money pre-tax at 15 cents in a dollar going into super. And so it's a really good tax play because you've got no other debt there. And then the other side of the fence is looking at whether or not you're going to stay where you are or you're going to move to a bigger, better house, because that chess piece just finds my next sentence. So what are we thinking?
We had this chat, didn't we, in the car on the way home?
We're a little of different minds, I think.
Yeah.
I think we were last time we talked to you about this. So
yeah.
Sam's keen on maybe another house. I'm keen to just buckle down here. And I mean, at the very minimum, I would love to have 2 years.
Yes.
2 years
just peace, financial peace. Yes.
Jump into another huge
100%. I'm with you. I'm with Jamie on this one, Sam.
Yeah.
I just think you guys have, it's like you finish this marathon. The last thing you want to do when you finish a marathon is go run another one. And so just have 2 years off of just play and live this feeling, which is like so rare. And then after 2 years, I think we just sit down. Okay, what are our options? Well, if we sell this place, then buy a bigger, better house, then obviously the proceeds from the sale, make sure that we've got a pretty small mortgage. We should be able to get on top of that pretty quickly. But also, if we don't do that and we do stay where we are, what investment property and portfolio can we start building? And those chess pieces are, it's very important to do the first one because your borrowing capacity, obviously you want to make sure you've got everything you need to get into whatever you want to do. And then we put that big rock in first, and then we put in all the other small rocks around it. So yeah, all I need you guys to do is tell me what you're wanting to do, and I'm going to tell you the fastest and smartest way to do that.
Yeah.
Well, we do have a few expenses that we'd probably like to do coming up. One of which, obviously, the car. The other is, I think, like you say, I would like to go to Canada every year. Next year, I'm planning to go, but just by myself.
Nice.
My dad's 80 now, so
that's a totally different trip. That's amazing.
I'll only go for like maybe 10 days or something, but yeah.
Make it 14. Go crazy.
No, I don't have that much leave, so I got
leave
that.
without pay. You don't have a mortgage. You're free. Whatever.
Well, I've actually gone down to 4 days a week at work.
Nice. Are you doing long weekends every weekend?
No, I'm taking Wednesdays off.
I actually do that as well. I tried the Wednesday. I love the 2 days on, 1 day off, 2 days on, 2 days off. And now I'm just in the middle of trying the Friday. So I'm just doing the long weekend. So I like the Wednesday. I'm also really liking the Friday. So I'll keep you posted.
It's been really nice. But actually, well, we talked about it. I just needed a bit of a mental health break, to be honest. And but I'm lucky enough because I have long service leave. So I'm using my long service leave for my
day off.
So I'm not getting any less salary.
Right.
It was the same for now.
That's the best.
So that's what we've done. But anyway, so so maybe Canada. We'd like to go to Japan next year with the kids. And the only big expense that I want in the house, well, not big, but bigger, is to do a small renovation in the front room, which is just to put in bookshelves and a fireplace in the front room.
Sounds like a great play.
Oh, I will. But
I love it. What are you thinking, Sam?
So obviously, as Jamie hinted at, I'm certainly keen to look towards getting a bigger house, one that has a bit more space for the kids. But I'm very much open to, especially given that you're both on the same boat on this one, saying let's have a bit of a breather where we allow a year or two, of just room to appreciate that. 2 years, that's all good.
I didn't believe I said a year. It was two.
Just I suppose revel in the fact that it's mortgage free, and as you said, have a bit of space there to breathe. So that's great. But I think that's really where what I'm looking towards. There's no immediate things that I have in mind beyond getting a car. You and I think it was we spoke about it, or perhaps it was Adam actually. We might have engaged you both on it, but the only thing that comes up from time to time for me is solar energy. But I think we sort of landed on solar not necessarily being the best investment.
It's something where, especially knowing what I see for the future for you guys, unless you're going to be staying in your house for 7 years, which is probably that's how long it takes for it to sort of get to that break-even point and then start sort of being beneficial. I just don't think the juice is worth the squeeze.
That was the advice. Yourself and Adam, I think, gave us last time. So I'm certainly, I suppose, ultimately, when we go to that next home, then, and Jamie and I spoke about it in the car just the other day, coming back from a little time away. then that would be great to have that sort of dream home where we do those things like put the
Yeah,
solar on
of course.
a bit, yeah, longer term. So no, I'm quite happy to just settle in and enjoy the trip,
Mm.
the trips and the travel.
In the
Yeah,
saving.
yeah, and the saving. Yeah, you're right.
Yeah.
Yeah. I had no idea, like you said, that there's actually even options out there now that give interest. Having just done my tax return for the last financial year and not even having anything
To
to
deduct.
declare in terms of
Mm.
interest, from the bank. I thought they didn't give interest out anymore, but that's good that there's options to.
No, because the rates are so high, the term deposit rates are so high. And so you'll be able to get 5% pretty easily. So I'll tell you what I would be doing if I was you in your position. And
Yeah, yeah, run it.
not saying you have to do this. I'm saying this is what I would do if I was Sam and Jaime sitting here today. So I've paid my house off. I'd take 2 years of just ultimate freedom and enjoy that, relish it, and just smile a lot because no one else is doing what you're doing. And there's going to be a lot of your friends are like, why are you guys so happy all the time? Like, what happens when you don't have a mortgage at 7%? And so enjoy that freedom, travel a lot, buy experiences for the kids and you to share. That's what most of my family, so the happiest have done is they've bought experiences rather than materialistic stuff. And that's the stuff that the kids will always remember. So just do as much that as you possibly can before the kids don't want to hang out with you anymore, which will come soon. And then at that point, you guys are then going to say, okay, we want a bigger, better house. And so great. What's the shortfall between what you want, what you're going to sell yours for, and that gap? Whatever that figure is, we bed that down. Once that's bedded down, then we're wanting to be looking at investing in property for two reasons. One is we got to set the kids up. And so I don't think there's any better way to set the kids up than to give them a property each when you guys pass on. And so we'll have your house paid off. We need to acquire one investment property for each of the children between now and retirement. So there's no rush between now and retirement. We don't have to pay them off. We just have to acquire them. And so get the bigger, better house, bed that down, then see what our borrowing capacity is, then look to purchase that first investment property over the coming year or two. And then from there, map out exactly when we'll get that next property. So we basically roll into an early retirement. I'm thinking 60 worst case scenario because retirement is just a number. It's not an age. Everyone thinks it's 67. It's just as soon as you have more money than what you can spend before you die is when you retire. We'd run all the calculations for you. And so there's no point in spending time for money when you've got more money than what you've got time left. And so we want to fast track that retirement. The properties will be positive cash flow by that point where the rent covers the mortgage. So you're not going to have to top them up at all. And so then you roll into retirement, the house is paid off, few investment properties, super's been maxed for these next 2 years. And you've just got like freedom to not have to think about money at all. And then the kids are going to be set up. You can spend all your super because the kids are getting a property each, guilt-free.
Yeah, wow. I love that.
I don't know, you're making it sound easy again. I'm skeptical.
This guy's, he's very scammy.
Sounds too good.
No, yeah.
No, that's good. That's good.
Fool me
Okay.
once.
Yeah, that's right. Yeah. Can I ask a question about
Sure.
so the way you've been speaking there is it sounds like the preferred path might be to like sell this property ultimately to then have a bigger, as you say, nest egg or money to invest into the next one.
Yeah.
I wondered whether or not I'm quite happy to do that. I'm open to like getting this place up to scratch for sale when the time comes. But is there any benefit to holding on to this place as that first investment and doing it that reverse way?
No. The reason for that is the whole name of the game is you want to have zero bad debt, owner-occupied debt, home loan debt, like you've got now, and maximum investment debt. And so if you were to keep this property here, it would have zero debt owing on it. And let's say you buy $1 million house, just for round figures, you'd have to borrow the full million. So you have $1 million on your home loan and zero on your investment loan. So you've got no tax deductions on the interest because the investment loan's paid off and you've got $1 million worth of bad debt, which is not tax deductible. And then from there, you're going to get all this tax on the rental income because there's no interest to offset it. And so it's best to be in the opposite situation where you are now. If you said to me, Scott, what's the smartest thing for us to do financially? I'm not saying this is the best thing for you and your lifestyle. I'm saying the smartest thing for financially is to stay where you are and start building the investment portfolio. And so you've got all these investment properties. You could probably pick up three or at least three, maybe four between now and retirement. Stay where you are. You have no bad debt, only investment debt. The tax brackets that you guys are in just plummet. So your taxable income is basically you're paying all this tax. You're going to get a huge amount of it back, probably $6,000 to $10,000 per year per property. And then you're going to be in a position where you've got no bad debt. The banks keep lending to you because you don't have any bad debt, versus that other situation where we keep this place as an investment. You buy $1 million home loan, you can't do anything. Like that's it. And like as a result, that's not tax structured effectively tax wise.
I'd like to understand that then. So that, yeah, okay. So it comes down to, yeah, as you said, bad debt versus good debt, and then yeah.
And so yeah, you want to do everything in your power to have no bad debt, which is what you've got today, and to maximize your good debt. And so the smartest thing financially is to keep exactly where you are with no bad debt. And now we just build investment portfolio. So investment Parry number 1 comes online, and then a few years later, investment Parry number 2 comes online, investment Parry number 3 comes online. And so you just have maximum borrowing capacity because the bank sees your position, go, oh, they've got no bad debt. All that you can borrow 5 times your gross salaries. So what's your gross salary at the moment, Jaime?
143.
And Sam?
100, yeah.
So let's call it 250 round figures. So you could borrow 1.25 million today to invest.
Mm.
Not saying you would do that, but like that's how the banks look at you. They'll lend you 5 times your gross salaries.
Yeah.
And so what that does, like, oh, okay, well maybe we could like pick up a $750,000 investment Parry now, and then in another year or two, grab another $750,000 investment Parry, and then we just sit, and the tenant pays for 70-80% of that. We just top it up by maybe $100, $200 per week each, and we're good. And then you're getting the growth on it. You're getting all the tax benefits, and that's that simple.
Basically, my understanding, Scott, is like if you had to do anything to that house, like an investment property, any renovations or whatever,
taxable. It's that what you just said there was really interesting. So you can do maintenance. So you put all your invoices down as maintenance, but not improvements. So the improvements aren't tax deductible. The maintenance is.
Oh, so it's maintenance. Okay, yeah.
It's always maintenance. Always maintenance. So yeah, that's where it starts. We really dial that in, and tax wise, you guys are just structured so effectively that you're getting tax returns of 10, 20,000 a year back, which then you can continually recycle into more investments. So
without going into detail on that, is it just as an example, is that what you do your tax return, and as a deduction, you would put in your maintenance on your property valued at $5,000. You spend it paint or whatever other maintenance you're doing, that then comes back.
You're getting your marginal tax rate back. So if you're on 30 cents dollar and that was 5,000, you get $1,500 back. For every dollar you pay in interest, you get 30 cents back. So your investment, probably, let's say your interest bill was $1,000 for the month, you're getting $300 back a month.
So, and that's interest on that mortgage, like when you buy that place. Okay, right. Wow. Holy shit. That's why all negative gearing's in the news all the time, trying to like shut it down.
Yeah. I mean, like, so for most Australians to get a $600,000 investment property, it actually costs them after their tax deductions maybe $100 a week.
Oh, wow. God. Plus, as you said, the growth on you're paying the property off, and
but the best part is if that suburb does 10% growth, you made 60 grand. You're getting 10% on the asset, not your deposit or not your shortfall on the cash flow. So that compounding over decades, like it's just a slam dunk.
Yeah.
So but let's say we do want to get another house for ourselves.
Yes.
So the idea is that we sell this one.
Yep.
Like you said, we figure out the difference between what we want. If it was like 1.3 or whatever, nowadays they're so expensive, but like whatever it was. So let's say we said we want to buy a bigger house.
Yes.
Okay. And the difference is 400,000, let's say. So then what? What do we do?
Which is you say, Scott, I found the property over at 1 Smith Street. We then go value 1 Smith Street. We then transfer this current facility that we've set up onto 1 Smith Street. You got a $400,000 loan on 1 Smith Street, and the games begin again.
Oh, there you
Okay. And then how long
Ah.
until we get an investment property after that?
Well, remember I said your borrowing capacity was 5 times your gross salary. So if nothing changes and it was still 1.25 million, take 400 leaves you 800. So you could buy your dream house and an investment property straight away. And then you'd have to pay that investment property down. Pay the new home down to free up your borrowing capacity. So you buy that second one. But it said we only need to buy that second one before retirement. So there's no rush to we have to buy them every year or two. Like we can do the dream home in 2026, then buy the investment property 2027, the first one, and then 2032, for example, we might buy that second property, but we're not focused on paying them down at all. They're all on interest only, where we're just paying interest, the tenant, the tax, all that sort of makes up 80% of it. But your focus is to get the new, bigger, better home debt-free so that you can roll into retirement without any home loan and without having to cannibalize your super fund. Because most people get to retirement with the mortgage, they use their super to pay off the mortgage.
Yeah, I know, I don't. Yeah.
That's a problem because then you've got no money left to fund your lifestyle in retirement.
Yeah, that's right.
Yep.
Wow.
Okay. And so then, I mean, presumably by then, hopefully I'll be making more. But so if we were to get this like luxury property that we want, and I wonder how long it would take us to pay that property off then. Probably depends on the difference, I guess. But
Depends on the difference, but you did 360 in 7 years, so I would call it 10.
10 years.
Yeah.
Yeah, cool. Okay.
Hmm.
And that would still be before what you imagine us retiring at. Yeah.
Yeah, I said I've got you guys.
I'm 44 now. You're 40.
Yeah, I don't think you guys will be working after 60. Like, there's no way you should be. But with this head start you've got, there's no way. How much do you have in super now, Jamie?
Not a lot.
Yeah, Jamie's
because I came to Canada or Australia late. And
Yeah, so that's where the properties will help you catch up that.
got 100 something, I think, don't
Yeah.
I? Oh, how much do I have?
No, you got way more than that, but you still.
I don't think I did.
Yeah, your super is much lower than mine because I've been with the public service for so long, which pays 15.4% super. They're much higher than the industry average. More generous, super coming in.
Can you see the screen?
Yep.
Yeah, cool. I just want to keep talking. I just want to show you what the
That's
super.
not where is that where we can have our retirement?
Yeah, look at that, Fiji.
That
Nice.
would be nice. I was trying to get you a bit of homesick. I'm not too sure what that is. It certainly looks American. So how old are you at the moment? 44, Jamie?
I'm 44, yeah.
Yeah, and your salary you said was 145?
I'm 43.
Yeah, and your super balance you said was, what do you reckon it is, Sam?
I think Jamie's super's only around 230, and that might be generous, but yeah.
I think that's
not
Yeah.
bad. Not
I thought it
bad.
was quite low.
You think it's lower than
I
that?
can Google it now.
Yeah,
while
you Google it then.
Maybe look at Sam.
Yeah.
Okay. And so Sam, how old are you?
46, and my super's 550. I think it's already over.
Wow.
Yeah.
Wow. Are you serious?
Yeah. Yeah.
Yeah. 550 in super?
Yeah. I can go double check it, but it's definitely
Double
over.
check that, man. That's insanely good.
I don't even
If
know
that's true.
Rest.
Yeah, rest you're with, but
And what's your salary at the moment, Sam?
100,000.
Okay. Let's say you retire at 60 on $1,500 a week. Today's money. Like, imagine you're living, obviously you're spending for food, fuel, and fun, plus your bills, $1,500 per week. Like, so let's go crazy. Let's go 2,000 a week.
Forgot mine.
Okay.
Jamie's just checking her super for you to punch it in. Yeah, I thought it was.
So, once we get Jamie's super, then I can do a calculation.
Okay. Okay, so that's me there, right?
There's your member.
Yeah. Where's my account?
Yeah, your account.
Oh, why is it asking me to log
I
in?
think you pressed X on it to log it out before it logged in. I'll double check mine while you do that.
Sorry, Scott, one sec.
No problems.
No, it's not letting me log in. I'm having problems logging in. Just it's not letting me log in. I'll have to find out for you then. I don't know why it's. Oh, this might work. What are you doing, Sam? Oh, he's checking his too. I think it's working now.
Sure.
Hopefully, if not, then my account. Here I am. Okay. There we go. I think this is working. If not, then I'll have to get it another time.
Yeah, sorry, it's not 500, it's 400,000, Scott. So you can change my figure.
Yeah, I was a little bit.
Yeah, I thought it was at 500,000, but I think I saw 400,000 and thought that's nearly 500,000. I probably just rounded it up.
Oh,
Yeah.
here it is. Mine is 132,447.
Oh, so you were right. I think you'd said it was 130. I thought it was over two.
Okay.
On both.
Wait, so let's let me
What you're saying makes a lot of sense around that salary sacrificing. My cousin, who's a financial consultant, was saying that's what he gets his people to do as well, just to sort of salary sacrifice into superannuation to whatever the limit is. Yeah.
that's it. So what was your balance, Jamie?
Hold on. Sorry.
132.
132,447.
130. Let's call it 130. And then Sam, yours was
100. Yeah.
just straight 400.
Yeah. Yep.
Okay, cool. So what this says, without any salary sacrificing, zero. So what I just talked about, pretend you just didn't do that. So we're just ignoring you, Scott. So we're 530 total in super. This is where we currently sit. And we just the employees are putting 27,600 per year.
Mhm.
We're going to get to retire on $1.3 million in total, which is how much you'll have in super by the age of 60. If you keep doing exactly what you're doing now without any without any contribution to stuff, that's going to give you $1,923 per week to live on, which is $100 per year. And so what that does is you guys hit 1.35 million there. I'd say we definitely need to chop out at the age of 60. And then we start chewing into the super, spending $2,000 per week every week. Every week you're spending $2,000 per week. I don't think you'll be able to do that. I would like to challenge you to that. And then you're going to run out of super at the age of 96 and 98.
Well, that's good. I mean, I think when you looked at it, didn't you say a sort of 1,500 to 2,000 per week is probably about, is that about average for people? Is that what that's?
No, man. Like most people are spending because the older you get, the more tired you get. You're not doing as much. Most people are spending about 75 grand per year.
Yep. Okay.
In which case, you'll still have like super left at the age of 105.
Oh, shit. Yeah. Okay.
Okay. So, as we talked about, there's no point in actually having more money than what we could spend before we die. Like you're not living to 105.
Yeah. Yeah.
100, you'd still be sort of having 200 grand left in super at the age of 100. It's silly. And so retiring at the age of 60. And so where this comes from is we need to look at it and go, okay, we're retiring at 60. Like, how much money do we need to make sure that we're never sort of going to be caught short there? So your
Like old age homes and stuff are expensive.
yeah, but you're going to have your house
Yeah.
debt free. So like let's say you're living at the current level you are today, that's 11,000 per month, which is 132,000 per year. So that's at today's level with all the costs of the kids and all the stuff. That's
Yeah.
132. So I'm saying you're going to be
And the mortgage.
yeah.
Yeah.
And then so it's basically a number where they say if you times your living expenses by 25, so let's say 132 times 25 is $3.3 million, is what you'd need to never be able to like touch the principal just living off the interest. But like no point just living off the interest. We want to chew in the principal.
Yeah, that's it.
So that's why we don't need as much. But based on my calculations, you never buy an investment property. You never do anything else except just keep staying the course, spending all your money, and don't invest. Then you're going to be in a position where I still don't believe you'll be able to spend all that before you retire at the age of 60. So there's no point working to 67 when you can't already spend all the money you would have accumulated by the age of 60.
Yeah.
So just to give us a sense, then let's say we did get those two investment properties.
Yeah.
What is it? How different does that look like? I guess it all depends on the property and stuff.
Yeah.
Well, it depends on the property, and obviously you want to get to the property to a point where it's washing its own face as fast as possible, and so you're not going to pay it off, but it's just not costing you any cash flow. And then you've obviously got surplus cash flow coming off that when the rent covers the mortgage and some. That's when it adds to that $1,000 per week or to $1,500 per week we just talked about there.
Yeah. Okay.
Oh man. Well, this has been such a good like meeting. I'm genuinely excited. It's like such a lovely position to be in. And really, I suppose just having this conversation and just hearing about what's possible and learning a bit more about it has made, I don't know, it's really made me feel
positive.
Really good on the inside.
So next step, Scott. So let's say we're gonna look to get the car. The holidays next year and maybe the Renault. Which I don't imagine be that expensive, but so then what about how do we do this maxing the super? How do we do the savings?
Okay. Yeah. So once you've got the car, then it'll go fund that, and then from there we'll go to zero. Once that's happened, then we need to start telling our payroll officer, okay, I want my salaries going into my spending account now. Okay, so you've got the big spending account numbers for that. And then from there, as the money's starting to build up, it's not going to be worth it if you've got 3, 4, 5, 7 grand. And once it starts getting over 20 grand in savings, like, okay, how do we get this money working for us? That's when the term deposits like Macquarie, ING, those sort of groups are really good.
How long are you thinking of a term deposit?
It all depends. Like some people do 3 months, 12 months. Like other people
like a year.
Yeah, 12 months is fine because remember you still got the mortgage if you need any extra money as an emergency. So it's not like you're we're all tapped out. But as of I would say this month, once you've got the car paid back, I'll then say to your employer, hey employer, you're putting in 11% of my gross salary. So for Sam, it's 11 grand a year. What that means is you need to top it up to 30,000. So you should be putting in at least another 15,000 a year, 300 a week on top of what your employer is doing just for the next 2 years while you're enjoying this debt-free life.
You just tell your
employer, yep. And then they start doing the salary sacrifice for you.
Yeah.
So then they basically say, okay, this is your pay. I'll put part of it into the super and then the other part hits your bank account.
Yeah.
Okay.
But make sure you don't go over that 30,000. And for Jamie, it's a little different for you because you're probably getting paid super on your bonuses.
Yeah, I just paid. Yeah. I'm sorry. Can you take that?
Oh, right. Yeah.
Actually, I'll take
go,
it and tell them I'll call them back.
Yeah. No, I'm all down with that. Absolutely. We'll get the car done first and get that sorted. It's great to be credited already to that position, as you said, about 26 grand there.
Yeah.
I think when we buy the car, this is just the question around. We'll have to obviously contact you guys and say we're about to spend 30 grand or whatever it is. And I suppose that's just a redraw. Is it just the normal process?
Yeah.
We just say we need a big, massive redraw.
26 GG, hit the account, or 30 maybe there.
Yeah. I was worried because obviously the credit's there, but obviously the total redraw will be not just the money we've got as credit, but it'll go back into
Correct.
it again because we'll have to dip into the mortgage. But that's not a problem for you guys. You can just send that money.
Send it like that.
Yeah, okay. So we just request a redraw as normal for the amount that the car is, and then do that when the time comes. Yeah.
I just got that bonus recently from work. It was what, $75,000 bonus, and I can't believe how much taxes I paid.
Yeah, it got hard.
30 grand in taxes.
We actually rang my cousin Scott and said, is there any way we can avoid the tax on this? Because it's coming in as a gift. And he's like, look, he suggested super. And he also suggested if it can possibly go to me, but then it depended on my taxable income was lower than Jamie. So he's like, maybe that would work. But it all just happened. It came in and that was that. It got taxed and it doesn't matter. We were so grateful for it. But yeah.
I mean, that is the downside of making a lot of money is you pay a lot of tax. So yeah, that's the game plan from here. That's what I would be doing. I think we're all on the same page. We know next steps: car, reno, enjoy 2 years of freedom, travel a lot, and then once you're ready, you find the right place at the right price. Scott found this property. We then want to acquire that. We then flip this facility onto the new place. It'll have a shortfall, maybe 400, 500 grand, whatever that figure is. And then we start to work that down between now and retirement. Start maxing out your contributions to super, speak to your HR employer about that. Say, hey, I want to get that going. So that's just going to boost those funds for the next 2 years. And then once you're in your home, then you stop that. Because then you want to start piling that extra money into getting that debt paid off before you retire.
Should we do that now?
Yeah, definitely.
Let them know. Okay. And then so we'll get the car, and then after that we'll be in touch with you about the deposits or something. Yeah.
So let me know once you've got that box ticked, the car's been paid back over.
Yeah.
Okay.
Cool.
Excellent. All right. So there we go. What a transformation. I just chatted with Adam earlier, and I said, mate, remember Jamie and Sam's house? He said, yeah, I remember going out. I said, imagine if they'd said no that day.
Exactly. Yeah. Well, no, it's true. It is true. Yeah.
And like you would have been like everyone else, just doing a 30-year thing.
Yeah. No, you guys have been great. Thank you for helping us get here. It's great. We're in a good position. So
I reckon I would imagine that you and I mean, we both are self-confessed hopeless at sort of getting onto that stuff. In fact, even this meeting, you had to bloody set it up for us. Like, invite, you're doing it at 11:30. Oh, okay, yep, accept. Like, yeah. So we needed that assistance really, because we would have just gone, oh, okay, that's just how it is. You've got a mortgage, and we needed the leadership really from you guys and the advice.
No, it's been wonderful. 60 sounds great. That's not
you love it. 60 is like very, very realistic. That's not rainbows and Skittles. That is very realistic.
And I can just travel and do my hobbies. Is that it?
You can.
That sounds pretty great. Yeah. Love it.
So congratulations. Enjoy this next phase of your life, which is you're just not going to know yourself. You're going to be like, what do we want to do now? Let's go. Let's do this. Let's do that. Your kid's going to be like, what happened to you guys?
They're happy.
This like, wow, this like, they're not saying no anymore.
True. Nah, this is wonderful. And I really like the idea of, I mean, what you said about the 2 investment properties for the kids. I hadn't even thought of that, but that's nice. I don't want to just give them everything, but it's nice that they have a security. Yeah,
because that gives you the peace of mind saying we can spend all of our super. The kids are going to be okay.
Yeah.
And so it gives you that peace of mind to spend the whole 1.3, 1.4 million that you're going to have.
Yeah, right.
Yep.
All right.
All right.
Excellent. Well, I don't have any more questions at this point.
Great.
Yeah.
Well, this is where it gets fun. So enjoy this. Anything else you need from us, let us know. But get the car sorted, get your super contribution sorted, and then
Yep.
from there, once we've done all that, then we can start talking about term deposits and where you should want to be stacking cash.
Okay.
Right.
So I just say to the employers, just can you max me out?
Or I would say your employer, I want to now maximize my super contributions to my cap. You guys know what I roughly get paid in bonuses, so don't go to the ceiling just in case there's some extra bonuses. But yeah, just get me probably to close to 25 grand a year in contributions. Just leave that $5,000 buffer just in case you do get a huge lump sum, because you don't want to go over that 30 to get taxed insanely high if you exceed 30.
Oh God. Okay. Yeah.
Oh, right.
And that
Okay.
cap of 30 is universal for Australians, is it? Like it's
Universal
not
for all Australians.
Okay. Yeah. 30,000 cap. Yeah.
Okay, I'll talk
Yep.
to them. They'll be good.
Yeah, that's their job. Like
Yeah.
that's what they do.
Yeah.
So,
Okay.
Cool.
We can do that.
Yeah. Easy.
excellent day. Well, so good to see you guys again.
Yeah, you're looking good.
Congratulations. And man, I'm not as good as you guys. That's for sure. Talk soon.
Thank you so much.
No worries. Bye.